What is going on, guys, and welcome back to another very exciting video. In this video, we're going to be taking a look at one of the most controversial stocks in the stock market, and that is Alibaba. And Alibaba had some interesting news come out today circling around the Chinese government and what they plan to do with interest rates. So we're going to go over that here today, and then we're going to take a look at the Chinese economy and what it could mean for Alibaba going forward. And then we'll leave off the video by checking out Alibaba's valuation and where its earnings are headed in the future according to analysts. So if you enjoyed the video, make sure you drop a like down below, and if you want to see more videos like this one, make sure you hit that sub button. Let's start off by taking a look at Alibaba's stock chart. We can see here today the stock moved up around 2%, over the last 5 days up almost 5%, over the last month up only 1%. Over the last 6 months we could see an incredible amount of volatility for Alibaba this year. At one point early in the year it was trading around $85. It spiked all the way up to around $120, then dropped all the way back down to around $80, again went up to around $100, and then dropped back down to around $80. And now it's starting another move upward and has gotten back to around $90. The question is, will it go back up to the $100 range or maybe even $120 range? And one of the reasons we're seeing this pop in Alibaba's stock price is that the Chinese government has unexpectedly lowered one of its key interest rates. This is leading investors to believe that there could be more stimulus in the coming months. The People's Bank of China surprised the market today by trimming its 7-day reverse repo rate from 2% to 1.9%. And the cutting of interest rates in China is really expected to help stimulate the economy. China has struggled a lot over the last couple of years with the pandemic, and the pandemic has led to a lot of distress in China within not only its industries, but also its real estate sector. And that is something that has had a big effect on China's overall economy. So what they are trying to do here is by freeing up money, by making money more cheap and more readily available to businesses as well as people, they are hoping to help stimulate businesses to grow as well as consumers to purchase houses at a lower interest rate. So all of this is really expected to help grow the Chinese economy and help their GDP growth over the coming years. Bloomberg has also jumped in and reported that the Chinese government is considering a range of other stimulus measures to help the country's real estate sector as well as broader demand within the country. And demand over the last couple of years has been a big issue within China. The first reason for that being the same as mentioned before. The pandemic has had a huge effect on the country. They have shut down complete cities for months at a time, and that is going to have a big effect on the overall economy. And what people don't often think about is when you shut down those cities, those people who had those jobs, they no longer have a job. They're either laid off or completely fired from that job. And that creates a number of issues. One, because that company is not selling goods and not producing goods, but two, you no longer have someone making money to spend within the economy. So both of those lead to lower GDP growth. And China has started to get away from their zero pandemic policy. It was rumored that they were going to target a date of March of this year to completely get rid of those policies. However, there were a number of riots throughout China by the Chinese people that really forced the hand of the government to get away from these policies a lot sooner. And we have already seen positive economic growth from the getting rid of these policies, where China has seen their economy grow by 4.5% in the first quarter. On top of getting rid of the zero pandemic policy, China's also tried to stimulate their economy with other means, such as lowering interest rates. We could see in 2020, when the pandemic hit, they dropped their interest rates from around 4.3% down to 3.9%. Since then, however, they've actually continued to drop their interest rates. So they went from this 3.9% in 2022 down to actually around 3.65% in 2023. And it looks like they could continue to drop this interest rate as time goes on. So you may think, how is it that China is able to continue dropping their interest rate while the US is stuck raising their interest rate? When we look at the chart for the US rate, we can see that they went from around 2.5% before the pandemic down to 0.25% during the pandemic. So they had around a 2% decline in their interest rate. However, China only went down by around 0.5%. And then what that leads to is the US has had to raise their interest rate from this 0.25% all the way up to around the 5.25% that we're sitting at right now. And one of the benefits that China has experienced from this smaller drop in their interest rate is that they have experienced less inflation. We can see over the last 5 years, they actually experienced a fair amount of inflation during 2020, where it got up to around 5.5%. However, since then, in the middle of the summer last year, when we were experiencing 9% inflation, China was actually experiencing only around 3% inflation. Another way that China has looked to stimulate their economy over the last couple of years is by decreasing their cash reserve ratio for big banks. Basically, what this means is how much cash that these banks have to have on hand and how much they can actually loan out, right? When you decrease this ratio, basically what you're saying is banks can hold less cash on their books and they can spend more cash loaning it out to businesses and individuals. So what they have done is they have dropped this rate over the last couple of years. We can see during the pandemic, it was sitting around 12.5%. However, it's dropped all the way down to around 10.75%. And this is another rate that they have looked to continually drop over the last couple of months to kind of help increase the amount of money that they can get out into the economy. With all of these policy changes, ultimately what China is trying to do is grow their GDP. And we can see that their GDP before the pandemic was sitting around growth numbers of 6 to 8%. We saw in 2020 a large drop off. That is due to the pandemic. It dropped all the way down to 2.2%. However, in 2021, we saw it shoot back up to around 8.1%. And then in 2022, we saw it drop in a massive way back down to around 3%. And this is really fueled by their real estate market crash. So with all of these stimuli that they're putting back into the economy, they're trying to get back to that 6 to 8% growth of GDP year over year. With all of this stimulus going on within China, you would expect not only their GDP and economy to grow, but also the businesses within China to grow. And that will obviously have a big effect on Alibaba. And Alibaba right now is sitting at a forward PE ratio of 9.55. In my opinion, that is an extremely low valuation for a company like Alibaba that still has plenty of growth in front of it. We see the S&P 500 right now trading around a 25 PE ratio, and that is a triple up almost for Alibaba from where they are trading at right now. Currently, analysts have an average EPS estimate of $8.38 for the current fiscal year. In my opinion, that could actually be low for where the company will actually perform. If we continue to see China lowering interest rates and promoting cash and spending within their economy, we could actually see these estimates come in higher than what analysts are expecting. So with all of that said, personally, I do own shares of Alibaba. I do like it for the long term. This isn't to say that China is going to be better than the US in the future. It's not to say that their economy is going to surpass the US economy and have better growth numbers than the US. It's just focused on what China could be capable of over the next coming years. I think the best thing for the world is when the US and China work together. However, you never know what could happen. There has always been some conflict between the US and China over recent history, and I think that could potentially continue. But in my opinion, I think China is poised to help grow their economy, and I think that is going to have a big impact on Alibaba's business. So keep in mind, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So with all that said, I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.